A beautiful home is the ultimate modern dream, but there is a startling financial reality most people ignore. The house you sleep in is actually a liability, quietly draining money from your bank account every single month. True wealth requires acquiring assets that pay you regardless of whether you clock in at a job. Before examining the specific properties, it is vital to understand the difference between hoping for appreciation and demanding cash flow. Buying a property and simply praying the market value goes up is a gamble that locks up your funds. True investing targets monthly cash flow, the hard income remaining after every single expense, from mortgages to maintenance, is completely paid. If a property consumes more than it produces, it is a liability, not an asset. With that anchor in place, let's explore the 6 primary ways investors build lasting portfolios. Single-family rentals. Start with the most familiar landscape. The classic residential home. Buying a single-family house, fixing it up, and renting it out to a long-term tenant is the foundational stepping stone for countless wealth builders. Families tend to stay in these homes longer than they would in an apartment, giving you a relatively stable, reliable stream of monthly income. The financial math is highly comprehensible, and if you ever need to exit the investment, you have a massive pool of potential buyers, including regular families looking for a place to live. However, this simplicity masks a severe vulnerability: the binary nature of vacancy. When your one tenant moves out, your cash flow instantly plummets to absolute zero. You are left covering the mortgage, the property taxes, and the insurance entirely out of your own pocket. It is an excellent starting point, provided you analyze the local rental market meticulously and plan for those inevitable empty months. The BRRRR method. Imagine being able to recycle your savings using the exact same initial pool of money to buy property after property. That is the ambition behind the BRRRR method, an acronym that stands for Buy, Rehab, Rent, Refinance, and Repeat. You hunt down a distressed, undervalued building, buy it at a steep discount, and orchestrate a renovation that significantly forces the property's market value upward. Once a tenant moves in and the cash is flowing, you go to a bank for a cash-out refinance. If executed flawlessly, the bank hands you a check that recovers your original capital, freeing you to do it all over again. But be warned, this is an aggressive, highly active undertaking. You are managing chaotic contractors, predicting complex appraisal values, and navigating shifting interest rates. A single blown budget can leave your cash permanently stranded in the walls of the project. Multifamily properties. If the total loss of income from a single vacant house keeps you awake at night, the logical progression is small multifamily real estate. Think of duplexes, triplexes, and 4-unit apartment buildings. By placing multiple households beneath a single roof, you structurally divide your financial risk. If one family moves out of a 4-unit building, you still have 3 rent checks coming in to cover the mortgage and keep the lights on. You can often buy these smaller multi-unit properties using standard residential loans, making them surprisingly accessible for newer investors. The trade-off is management intensity. Apartment tenants often transition more frequently than single-family renters, meaning you will spend more time cleaning, painting, and screening new applicants. Yet, for those seeking a sturdier cash flow cushion, this is a powerful evolution. Fix and flip. Television networks have built entire empires glorifying the rapid-fire excitement of house flipping. You buy an undervalued property, renovate it aggressively, and sell it a few months later for a lump sum payday. Make no mistake, a successful flip can inject a massive surge of capital into your bank account. But from a strategic standpoint, flipping functions more like a job than a passive income vehicle. You are trading your intense physical and mental labor for a one-time paycheck, meaning the moment you sell the house, the money stops. It requires clinical precision, buying at the perfect discount, restricting renovation costs fiercely, and timing the housing market perfectly. It is a fantastic tool for generating upfront cash to fund a portfolio, but it is rarely the final destination for investors seeking actual time freedom. Commercial real estate. For investors who have mastered the residential landscape, commercial real estate represents the heavy machinery of wealth generation. This arena includes office towers, sprawling industrial warehouses, and bustling retail shopping centers. The economics here are entirely foreign to standard home buying. Commercial tenants often sign binding leases lasting 5, 10, or even 15 years, providing a profound level of cash flow certainty. Even better, they usually have a vested interest in keeping the property immaculate to protect their own business brand. greatly reducing your maintenance burdens. However, the barrier to entry is towering. The purchase prices are enormous, the banking requirements are intensely complex, and navigating specialized legal liabilities requires a seasoned team of advisors. It is almost never the right place for a beginner to start, but it remains a magnetic finish line for seasoned operators. Raw land. At the far end of the spectrum lies the ultimate exercise in patience. Untouched, undeveloped dirt. Buying raw land strips away all the frantic headaches of traditional real estate. There are no leaky pipes to fix at midnight, no tenants to evict, and no structural foundations to fret over. You can buy into this asset class for a fraction of the cost of a developed building, holding it while you wait for the city's infrastructure and residential zones to sprawl outward and envelop your property. But this tranquility comes at a steep price. Land produces zero monthly cash flow while you hold it. In fact, invisible dangers like sudden zoning changes or surprise environmental protections can instantly paralyze your ability to develop or sell the acreage. Land is a multi-year waiting game reserved for patient investors who already have strong cash flow pouring in from elsewhere. Ultimately, deciding where to deploy your capital depends entirely on an honest assessment of your current reality. How much time do you actually have, and what is your tolerance for financial risk? Leverage, the art of using the bank's money to control a massive asset, is a financial superpower, but it can amplify your losses just as quickly as your gains if you leap in blindly. Financial education must always precede leverage. Remember, this overview is for educational purposes, not personal financial advice. Choose the path that matches your current knowledge, verify the math fiercely, and remember that the goal is not just to own property, it is to buy your own time back.